Good morning. This is Brad Shively with Capital Management Corporation. I just want to thank everyone for signing in today. Right now, we're waiting for a few more people to sign on. So we'll start the formal presentation here in a couple of minutes. So bear with us. Appreciate it. Thank you so much. Good morning. So I appreciate everyone's patience. Brad Shively here once again of Capital Management Corporation. Appreciate everyone dialing in today. We're really excited about a few of the things we've got planned for this year as far as our strategies. But definitely, 2019, we're starting off the year with further continued uncertainty around domestic growth, rising rates and inflation, trade wars, and Washington gridlock. We understand that. And all this on the heel of probably one of the worst performing S&P 500 finishes since the financial crisis. So we really wanted to reach out to everyone to kind of tell you where we're at, our thoughts on the strategies and our outlook for 2019. Before we get too far into it, though, I just want to point out on the webinar here, everyone's in listen-only mode. But if you do have a question, and we did receive questions in advance, which we will be addressing after a short presentation here from Mark and then Tim as well. But you can type in on the question area where it says questions, any questions, and we can address those as well live. So just to kick it off here, I will now pass the call on to Tim Call, Head of Investments, and Mark Livesay, Head of Portfolio Management. Mark?
Hi, everyone. Thanks for joining the call. We have a few slides to illustrate some of what's been going on in the market and capture some of our thoughts for what will go on in the market. The first slide is the volatility index. In layman's terms, this can be considered a fear gauge. So this goes back 10 years plus since before the financial crisis, and we can see fear has spiked up a number of times since 2007, and most recently at the end of 2018. And we see a couple of the reasons for the spike up in fear. It's important to remember when we're going through a decline in the market of 10, 15, or maybe even close to 20%, that this is somewhat normal. These things happen all the time, so we can go back and look at what we were scared about over the last 10 years. So the most recent was rising rates, and I would put, Fed balance sheet in that rising rate bucket. Trade, obviously trade with China and our other trading partners. Peak growth, so there were fears about growth slowing from here and then maybe even turning negative. So the market fell on a closing basis 19.8%. That's the biggest fall since the financial crisis. We nearly got there in 2011, where we had the U.S. downgrade, Europe periphery stress, and the market fell 19.4% in the summer of 2011. We've had double dip fears. We've had a taper tantrum. We've had global slowdown fears. We've had the beginning of 2016. There was uncertainty about global growth, and the market fell 12%. This most recent period feels a little like that period to me, where the real factor influencing the market downward is that growth is going to slow or go negative. In 2016, the market only fell 12% for about the first 5 weeks of the year, and then proceeded to go straight up for the next 2 years, essentially, until we got that correction at the beginning of 2018 in late January, where we had inflation fears. So, of course, inflation fears means that the market and the economies throughout the world are too hot, and now peak growth means that things are too cold. So in a 10 or 11 month span, we went from the porridge is too hot to now the porridge is too cold. And of course, where we want to be is in that sweet spot, the Goldilocks spot, where it's neither too hot nor too cold. We believe that with the market fall, we might be setting ourselves up to be in a longer, prolonged expansion where we're neither too hot nor too cold. So I think it's very important to remember that volatility is normal. This absolutely happens all the time. While you're living through it, it never feels particularly comfortable. It never feels normal. Your normal emotions tend to tell you that this could be it. This could be the big problem. But we do not believe that's the case this time. So moving on, the question is, are we heading towards a recession? And short answer is, in our opinion, no. There are some reasons for that. Bullish signals that would steer us away from recession are the lower corporate tax rate, less regulation, corporate repatriation of cash from overseas. We think there's over $2 trillion available. We're only about 25% of the way into that. Rising consumer spending, that's probably the biggest factor, is the consumer is 70% of the economy, and the consumer has a job, has rising wages, and is doing really well. And then we have record corporate earnings. So 2018 will be the highest corporate earnings in history. So that's very good. We believe 2019 will also have growth. So that is a little bit of a, I don't want to say controversial, but uncertain opinion, but we do believe 2019 companies will have earnings growth. Potential bear signals. So these have not happened yet in some cases, but potentially things we're looking out for. Have there been heavy equity market inflows? The answer there is no. There's not over exuberance in the market, in our opinion. We haven't seen heavy inflows into the market like you would typically see at a peak. Rising real interest rates. Interest rates rose for the first 9 months roughly of the year and then fell. The 10-year Treasury hit, in round numbers, 3.25 in early October, and now is down in round numbers at 2.75. So we've had a 50 basis point decline in the long-term interest rate. Lackluster earnings surprises. Certainly for the first 9 months of the year, we did not have that. Earnings surprises were positive. We expect that to continue with our companies. There are some big companies that have had negative earnings surprises, namely Apple, which has probably been the one that people have seen and been the most talked about in the press. We believe that's somewhat of an idiosyncratic situation where you have a company dominated by a product which is pretty well saturated in the market. So we don't think that's great signal for the overall economy. An inverted Treasury yield curve, we've got a slide on this in a minute, but we have not inverted yet. That is something we're looking at. The inverted yield curve has been and can be a good recession predictor, but the good news about it is it tends to be forward-looking. So we tend to get a little bit of time after the U.S. Treasury yield curve inverts before a recession, and that has not happened yet. Then a shift towards defensive stocks. Typically, the market moves before the economy. Certainly in 2018, more aggressive growth stocks massively outperformed less aggressive value stocks. That did begin to shift a little bit in the very end of the year when you had the volatility spike, but we don't see that continuing for very long. So we don't think that shift is going to happen. Part of the reason for that is defensive stocks. So your utilities, your consumer staples, and stocks that are known as being defensive are very expensive. Typically at the top of a market, those get very cheap, and people want to pay for growth, not pay for stability. So we don't think any of those bear signals are with us, and the bull signals are. Tariffs, just a quick note on that, obviously getting a lot of press right now as we talk with the Chinese. Global tariffs, you can see the little green bar on the far right, how that compares to what the cash from the corporate tax cut, the individual tax cut, and then repatriation is for 2018. So we believe the tariff issue will eventually be solved. It's very hard to predict when. There's a deadline, I believe, in March, and maybe we'll get good headlines prior to that and then bad headlines, and we'll have volatility in the market, and maybe we'll extend it. Maybe we won't, but we do think ultimately the tariff issue will go away, and that will be a positive for the market. We think the United States will be in a better position than it was before we entered these talks. So that's going to be good long term for our companies, our intellectual property, and also will allow companies to plan better. And we think global growth could accelerate once these talks have been finished. But keep in mind, the impact and the total size of these tariffs are dwarfed by potential repatriation, what's going to happen with the individual tax cut and the corporate tax cut. And of course, these tax cuts are recurring every year. So the tax law has not been changed. And if nothing changes, the corporate tax cut goes on forever, and the individual tax cut stays for another 9 years. So we think these are very positive factors. Speaking to the yield curve, this goes all the way back to 1962, and it is the difference between the long-term and short-term rate. So you see the vast majority of the time, longer-term rates are above the line or above short-term rates, so the spread is above zero. There have been instances where the curve inverts and we do not have a recession impending, so those are the red dots. You can see the green dots are more outnumber the red dots. However, that's when you had a yield curve inversion, and then months later you had a recession. So like I said, the good news about this is you typically have 12 months or more before you actually get to the recession. And the other part of the good news on the far right is that we have not inverted yet, although we are aware that we are close to inversion. One note on the yield curve inversion that's different this time, and every cycle is going to be different. So you can always say that it's different this time, but global interest rates are so very, very low that it's hard to imagine that's not impacting our longer term interest rate. So our long-term rate at the 10-year Treasury at 2.75 compares to the German 10-year Treasury of roughly 25 basis points and the Japanese 10-year Treasury of just above zero. So were we sitting in Germany or sitting in Japan and we were deciding where we were going to loan our money to which government for a return, we could loan it to our home country government or we could loan it to the U.S. government. And if we loan it to the U.S., we get roughly 10x if we're in Germany and much, much more than that if we're in Japan return. So we might decide that, okay, we're going to take that currency risk and we're going to go ahead and invest in the U.S. government bond because we're confident that they will give us our principal back at the end of the bond period and we're going to make much, much more money. So I think global factors are influencing our long-term rates down. Of course, the Federal Reserve has no control over the 10-year Treasury. It only controls the overnight rate. And we're nine rate hikes into this cycle. So the difference between the overnight rate and the 10-year rate is getting very, very, very close. We believe the Fed is aware of this. They're not operating with their head in the sand. I think some of their communications have been rattling to the market, and there's a new Fed chairman relatively, and he's never done this before, and he's going to learn on the job like many people do. So I think he's getting better at his communications, and more recently he has indicated that rate hikes are not preordained, and the balance sheet runoff, which is planned or will happen if they don't change it, could be changed. So we don't think the Fed is going to be nearly as aggressive in 2019 as they were in 2018, and that's a big change, which should be a big positive for the market. So although we're keeping our eye on the yield curve, we're encouraged that it has not inverted yet. We're also encouraged that we usually have a good amount of time between inversion and when a recession actually happens. So I've kind of hit on some of the negatives potentials, and I'm going to turn it over to Tim here to talk about some of the things that are actually positive going on in the market, because there are plenty of those. So I'd like to turn it over to our President and Chief Investment Officer, Tim Call, for a minute.
So this next chart shows where the money's flowed in the last 10 years. People worry about bubbles. Almost all of the money that's flowed into mutual funds and exchange traded funds that are registered with the SEC in the United States, the vast majority has gone into bond funds over the last 10 years, keeping interest rates low. We think interest rates, especially long-term interest rates, are too low, and being kept low because people are overly cautious about the stock market after the dot-com bubble burst and the financial crisis and the Great Recession that encompassed those. It makes sense that people are cautious about equities, but the 100-year track record is 10% per year. So if you want to overcome inflation and 30 years of retirement spending, you need some exposure there. But where we see the bubble is more with low interest rates, not with stocks at this time. Then with valuation on this chart, there's 6 main ways to value the stock market. 5 of them show the stock market undervalued, some by a lot. The one that doesn't is the CAPE or Shiller's PE. That includes 10 years of earnings. Right now that includes the 2 worst years, 2008, 2009. 2008 was the only year of negative earnings for the S&P 500. It was greatly negative because of a different GAAP accounting where you had to write off intangibles if you couldn't prove the value. So as we add 2018 earnings to the CAPE Shiller PE and take off 2008, we'll see the Shiller's PE go down considerably, and then all these factors should show that we're undervalued relative to the long-term average. As long as we're between those, the top and bottom dotted line, we think we're at fair valuation, but obviously we're below the mean right now. And when the economy is growing and growing at above 2%, and you're below the long-term mean, we believe that's a great buying opportunity. And when we look at the market in general, 10% pullbacks in a growing economy historically, on average, have been good buying opportunities. 20% pullbacks in a growing economy might only happen 3 or 4 times in a lifetime, and they are, on average, great buying opportunities. So hopefully history repeats itself. Turning to the next chart, there are a lot of risks. So the media will highlight a lot of risks because risk is more exciting. And so you have market risk, which we felt, large cap stocks down 20% and small caps down around 27% around holiday time from their peaks. Event risk, things can happen, including trade wars. We see some of those improving. going forward, where we know of those uncertainties. We're well aware of them now, but some of the talks might bear some fruit over the next year, just as we came to an agreement with Mexico and Canada. There's interest rate risk that Mark highlighted, and we think the Federal Reserve is going to slow down on raising interest rates. But we do believe long-term interest rates will eventually rise, which means the value of today's long-term bonds will eventually fall. No one will want a low interest rate 30-year bond when interest rates are higher. There's two risks that aren't discussed very much, inflation risk and longevity risk. So you want to build wealth going into retirement, certainly. In retirement, statistically, either you or your spouse will live 30 years, at least one of you. And there's some factors that can elongate that. If you've been to college, if you have a doctor, if you are not grossly overweight, if you're not a smoker, not addicted to drugs, you'll do better than the average American. So your money has to last a long time and beat inflation over that time, but also fund expenses. So when people say, I want to preserve wealth, it's very hard to do that in money market or short-term bonds. You can barely match inflation sometimes by investing that way. So you wouldn't make up for any expenses that might hit your portfolio if you have to replace a car, or if you plan on withdrawing 4 or 5% of your portfolio every year to live off of. Well, between that and inflation, the long-term average being closer to 3%, that means you're withdrawing 7 or 8% of the portfolio annually. Stocks would sure help in that with their 100-year average of 10% returns. So those are risks that we think are underappreciated. When we look long-term, you do see different investment categories. This is the top line. If you invested in 1970, put $10,000 to work, that, if you reinvested, would be over $1 million. So that's the green line at the top of the page. If you did not reinvest your dividends, instead, if you lived off those dividends, your portfolio would have grown to $325,000. It's still terrific growth. Your wealth would have grown faster than inflation, even when spending those dividends. So this is a power of long-term compounding. Compounding is an investor's best friend. Problem is, you have to be long-term. You have to ignore some of the volatility, even though it's annoying. When we look at the economy, we see these are the major components, and we highlighted that in our newsletter last July. The biggest part is consumer consumption. So that's almost 70% of the economy. When we look at MasterCard data, holiday spending this last year was up 5%. Well, the U.S. consumer tends to spend everything they make. And there's rising employment. And the employment market's very strong. This is the first time it's ever been measured that there are more job openings in America than job seekers. Because of that, people are voluntarily leaving their jobs to find companies that will pay them even more. And in aggregate, there's around 3% wage increases that took place in 2018. I don't feel like that's much, but that's much greater than what we've seen in any of the previous 10 years. So with more jobs and with raises, the average American has more money to spend, and it's being spent. So 70% of the economy growing at 5% is terrific. On top of that, government spending is growing at the federal level. You have entitlements need to be fixed. But until that happens, federal government spending will grow, regardless of all the other negotiations that take place. At the state level, states are going to receive a huge windfall with the repatriation tax. They didn't lower their tax rate. They get all the money up front. And states act like consumers on average. They tend to spend all the money they get. So we expect government spending to rise over the next year and long term. Investment, that's capital spending. Again, the repatriation brings back money, some of which can be used for increased capital spending, reinvesting in the company. We saw capital spending rise by 5.5% in 2017 and 5% last year. The bears will say, oh, that growth rate is really slowed. But we think 5% is still a strong growth rate. And when we put the 2 years together, obviously capital spending is growing faster than 10% over that 2-year period. Housing is in 4% of the economy. It's not growing right now. We think that's because it's labor constrained. It's very hard to find workers. If you try to renovate part of your house, if you're lucky enough to get workers, maybe they'll show up at night or on weekends, and you better be nice to them so they keep showing up. So we think that's a major reason why housing is somewhat flat right now. Also, the demand for housing is with less profitable houses, starter homes. As the millennials move out of their parents' basements, they want a starter house. It's less profitable to build a starter home. So if you're labor constrained, you're going to try to stick with building the high margin houses. Anyway, the 3 big areas represent 99% of the economy, growing at roughly 5%. Housing, 4% growing at 0. -3 is exports and imports, and that's where the trade wars are. Because we're a net importer, the trade wars do not hurt us as much as the other parties. So when we look at the overall markets, we see lots of reasons to be positive. The blue line at the top of this chart has a big caveat. If we ignore the 100-year track record of the stock market going up 10% per year or doubling every 7 years, so that's history over the last 100 years. If we just move that to the side, that's something really big to move just over to the side. We have many factors listed here showing why we're positive about the market. The top 5 are very, very big. If we just had one of those, we would be above average in our being positive on the markets. But having those 5 is quite meaningful. So when we look at how we're feeling about the market, we do see volatility returning. We see the trade wars adding some uncertainty, and Federal Reserve interest rate increases and reverse quantitative easing. We think these are now known factors. Some of them will improve over the next year. The Fed will not increase interest rates as much, and the trade wars will work. Some of them will work their ways out. So we see continued economic growth. We see taxes and regulations being positive for corporate America, and the valuation's extremely compelling, and it's a very important factor, the starting price for your forward returns. We greatly favor stocks over bonds for long-term investors right now. And so we'll be glad to take your questions, and then we'll provide a little summary at the end.
Once again, this is Brad again. If you have a question, please, you can go in there and type it in on the webinar. And once again, we also received a fair amount of questions in advance. So we'll get right away into the questions. First question, Tim and Mark, given the market decline as well as your positive sentiment for 2019 on your outlook, what sector allocation adjustments, if any, or portfolio positions have you been making with valuations obviously getting more attractive?
So valuations are much more attractive, and some areas that have been beaten up benefit from economic growth, such as the financials. The people are worried that a flat yield curve is not good for the banks, but there are a lot of other financials out there that benefit from rising interest rates, no matter whether the yield curve is flat or not. So insurance companies, transaction-oriented companies benefit greatly from rising interest rates. They have huge cash balances that they need to invest. They have maturing investments they need to reinvest. So financials are an area that we're overweight. There's still a lot of technological innovation out there, and aging baby boomers, and where we can merge technology with healthcare is in biotechnology stocks. We see a lot of attractive opportunities there. They have sold off greatly in the last 2 years, so they're at a very attractive entry points, and some of them have major discoveries they're benefiting from right now or in the near future. So we're very attracted to biotechnology and overweight that area.
Also to mention the consumer, we talked about the consumer being 70% of the market or the GDP and a big part of the U.S. economy, and we feel very good about the consumer based primarily on employment and rising wages. We didn't mention, but what has been going on too is oil prices have come down, so gasoline costs have fallen meaningfully. So that's going to be a positive for the consumer. The consumer has been an area where we've had an overweight position, and we continue to hold that. It's a little tricky. You can't just go buy any consumer fund or something that you want, because retail is in flux. So you have a massive player in Amazon providing retail services that weren't provided 20 years ago, and you have brick and mortar retailers adjusting to that, fighting back. So that is a tough area, but some areas of retail or the consumer where you can get exposure is in travel and leisure and things like that. And we have a very positive view on the consumer in those areas, particularly millennials who tend to spend more on experiences than goods. So we think that's a trend that could continue for a while.
Okay, great. Next question. Assuming the Fed remains dovish, 2 to 3 rate increases in 2019, and GDP growth in the range of 2.5% to 3%, is it reasonable to expect inflation to remain in the current range till global economic conditions create increased demands for goods and services?
So the global economy it slowed a little bit, still growing in aggregate, but not as fast. So that takes off some of the inflation pressures near term. Also, as Mark stated, the lower gas prices helps offset some inflation. So when we look at 2019, we don't see inflation as a large concern. Going forward from that, the world economy could strengthen, and prices could rise. So we do see inflation as a long-term concern, and that's another reason why we would stay away from long-term bonds at this point. To some regard, inflation reflects a strong economy, and economic growth is historically rather good for the stock market. There's great correlation there. So as long as inflation is not out of control and is caused by a growing economy, it can still be good for many companies and many stocks.
And one other point on inflation that I think, my own opinion, is the Fed is missing the fact that there's a large part of the population that is currently not counted in the workforce, which could come back. So the Fed worries about inflation getting out of control because they see the unemployment rate near record lows. And I think there are people that are, the underemployed or people that have left the workforce that are being drawn back in. So if you have more supply of labor than you really believe you have, that's another thing that could dampen inflation, and something I think that the Fed is not correctly forecasting right now. The most recent jobs report in January was very strong. I don't know if everyone saw it, but it was over 300,000 jobs added And we also added a lot of people to the workforce. So even though we added more than 300,000 jobs, the unemployment rate went up, which is unusual. And you don't see that all the time, but you do. That is an example of how you can have more workers than you actually think you have. So I do think that will keep inflation relatively tame over the near term. The problem is over the long term, you run out of those people. So there isn't an infinite supply. So longer term, inflation is something to very much keep our eye
on. And just a follow-on to that question around inflation. If so, what type of bond positions would you feel is prudent to add to one's portfolio?
With a flat yield curve, there's no need to take risk in 30-year bonds. You don't need the longevity or duration risk. You can get almost the same yield by just buying a 2-year bond. Now, if you're buying individual bonds, the custodian or brokerage firm could have a wide bid ask. So when looking at maturities of 2 to 3 years, there are some short-term bond funds and ETFs that we find to be very attractive right now for bond investors. So we think a laddered portfolio, but certainly emphasizing the 2 to 3 year maturities. That way, when inflation does pick up, you can reinvest at higher rates as opposed to having your money locked up in the very long term and having your bond values go down with rising interest rates and inflation. With a growing economy, usually you benefit by taking a little bit of credit risk. So corporate bonds should do a little bit better than treasuries. So in an IRA, we would recommend more corporate exposure, and in a taxable account, would recommend to consider a municipal exposure. And again, for the 2 to 3 year range, there's some really good funds in both categories.
Great. And once again, if you have any questions, please feel free to type them in. Next question. It seems the national debt is not discussed anymore. With the growing federal deficit, how will this affect the stock market going forward?
So the deficit, depending who you ask, it's growing toward 20 trillion. That's the total debt. The economy is a little bit larger than that, so it should be greater than 20 trillion this year. So that is a lot of debt by historical standards. There are countries with a lot more debt, such as Japan, that have negative demographics. They'll have a great portion of their, huge portion of their working population retire soon. So their working age population is shrinking very fast. So they will be a good country to watch as to see how you can operate with a national debt much greater than the size of your economy. The U.S. is almost at 1-to-1 right now. So it's a lot of debt. When we look at the forecast the government provides, they do assume higher interest rates that they're paying on their debt. So we find the CBO forecast to be good in that regard, but they have been underestimating economic growth. So one thing that helps you when you have a lot of debt is to grow your earnings with the government to grow the economy so that they get more tax revenue. We see that happening. We think that's underestimated. Also, inflation helps those who have issued debt because it makes the debt in general worth less. The bonds are worth less because of recurring inflation. So those are trends we see. We are worried about entitlement spending. Ronald Reagan provided a 30-year fix to entitlement spending. We're past 30 years. We need to slow entitlement spending. That's the vast majority of the federal government spending. So it doesn't matter what happens with the fights on the rest of discretionary spending. That's peanuts compared to entitlements. So a lot of fixes need to be made. You need some strong leaders in Washington on both sides of the aisle to do that. So hopefully we'll get some fixes with that over the next 5 years.
And one reminder on the debt is we do have a printing press, so it's very unlikely that we would not pay our debts because we can just print money and pay that with the newly printed money. The cost, so to speak, of that would be runaway inflation or much higher inflation than we already have or than we would normally have. We're running low inflation now. So I think much higher inflation would be the number one thing, the number one negative with the debt really becoming an issue. So it's kind of hard to imagine that right now. We've just lived through a decade of very, very below average inflation, and we've had great demand for our bonds throughout the world. I mentioned interest rates earlier in other foreign countries and why that might be attractive to bondholders in other countries. And I don't think in the next 3 to 5 years that's going to be something that really derails the economy. It is something to keep an eye on, and I think it's obvious to everyone that if we were running a surplus, it would be better than running a deficit. So that is a negative out there, but it's nothing new. We've had a deficit for quite a long time, and we do have that printing press, which helps. You can just print cash and pay people off with it.
So that's not the best outcome, but the countries you've heard about that have had trouble with their debt do not have the debt in their currency, or they don't control the currency. So there are a lot of third world countries that have their debt denominated in U.S. dollars. So they run into a lot of trouble when their economy falters. And even in Europe, if Italy or Greece have some issues, they don't control the EU currency. So they have to negotiate heavily with the European Union when they're in trouble. So it is nice that we do have control over our currency, but we hope there are better outcomes such as entitlement reform.
Great. Next question. How much of your positive thesis is based on a resolution of trade agreements going forward here for 2019?
So we have a lot of small mid-cap companies in the portfolio, and they do not have as much global exposure. So when we compare ourselves to the S&P 500, we'll say we have a much lower exposure to foreign markets. And when we look at China specifically, the vast majority of our companies do not have any dependence on China. So if that's the trade war we're worried about, again, Mexico and Canada have come to an agreement with us that's beneficial to us, and we just need Congress to pass it in the current form, and that will be resolved if Congress passes it. The EU, they've come to the big picture settlement. They just have to work out all of the wording. So hopefully they will be able to do that. Japan is intensely negotiating with us right now. South Korea has finished their negotiations, and we have new trade agreements with South Korea that benefit us. So the greater unknown is China. It's virtually a dictatorship now, where the current leader can stay there for life. So it's his decision as to how much they acquiesce. They're in trouble with a recession that they haven't admitted to yet, and they've already they've given in on so many issues already. They've passed laws that enable them to not have as much control over foreign entities and foreign enterprises. They have lowered their tariffs with other countries, showing us an example of what they can do with us. They've started re-importing goods that they had banned. They desperately need items from us like soybeans. So the picture appears to be improving. Hopefully we can get to a mutually agreed to settlement. Most of the benefit would be toward the United States if that were to occur. So the unknowns are visible. As we receive some settlements to these unknowns, there's less uncertainty with the markets. When the markets have less uncertainty, valuations tend to rise. So we see progress, and as there's more progress, the market could benefit.
Yeah, I'd just like to reiterate Tim's point that fundamentally our portfolio is not very exposed to China and what goes on with the tariffs and trade wars. But the sentiment for the overall market, which obviously will impact the valuation of the companies in our portfolios, will be impacted. So from a sentiment standpoint, we think the market can climb this wall of worry, to use the Wall Street jargon, and go to a higher valuation. From a fundamental perspective, we are not overly concerned with any of our companies, many of which have zero exposure to China. So if China's in a recession, it would not impact the company at all. So from a fundamental perspective, we don't have in our opinion, a very big risk. From a sentiment perspective, we believe the risks are skewed to the upside because the downside has been discovered, and a resolution, I think, would provide a lot of upside.
I appreciate it. That seems to be all the questions we have, unless someone wants to send in another one here, which we're more than willing to answer. At this point, though, we'll pass it on to Tim for a few closing remarks here.
So despite the increased market volatility, which regretfully is somewhat normal, and then the trade wars, which we think are starting to work their way out, and then the Federal Reserve increasing interest rates, we think that will be a much slower pace. So despite those negatives, some of which should be improving, we still see continued economic growth, which is very important for the market.